Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields lower, and again, failing to get to that 3% level we've been talking about. Yeah, I still think it's on the radar, but it just may take a little longer than we'd earlier thought. We moved yields down almost to 280 today. Lowest it's been in a few months. I think a lot of the buying we're seeing, as opposed to Treasury selling, which we had been seeing, comes on the heels of a couple of things. Obviously, President Trump talking about adding tariffs. Then you had Powell talking about rate hikes and growth. And lastly, I think perhaps some of the positioners maybe thought, we may not get to 3% today. Looking to maybe short cover a little bit. There's a lot of reasons why bonds may have a short-term bid. We'll have to wait and see if there's any sustainability and follow through to that. And if you look at market volatility remains elevated despite the fact that we are heading back into the old range, which would maybe cause volatility to come down. We aren't seeing it. So we are still in an elevated volatility level, not only in rates, but also in equities. So a lot of this uncertainty that we're seeing in the markets I don't want to say it's a flight to quality bid yet in the bonds, but it could be working its way there. And if you look at maybe the catalyst for this, well, what happened on Tuesday when we had new Fed Chair Powell speak? Since then, we've seen 10-year yields drop about 12 basis points. We've seen S&Ps drop about 125 handles, and we've seen gold down about $35 while the dollar rallies. So everything seems to be turning around here since Powell gave his first testimony, and that could be the catalyst. Is that what we didn't think we didn't know, we don't know, if that makes any sense. And right now, Powell is talking about gradual rate hikes. That's a good thing. He's talking about economic growth. That's another good thing. But inflation remains a question. Some of the data we've received in housing remains a question. You've got President Trump talking about tariffs, which could inadvertently create inflation. It's helping, obviously, certain industries and commodities, but it's going to hurt others. So there's a lot of uncertainty out there. And perhaps this bid to the bond market that we're seeing, while it's very small in a macro picture, could just be that. And so I think that we have to wait and let the dust settle here. Equities are really the driver of this market. As we see equities get hit, I think the bond market follows suit. And instead of seeing bond selling like we have over the last month or so, we're now seeing bond buyers, given that we are near a very critical level of 3%, which we did not get to. But again, I do think we'll get there. It just may take a little more time. Next week, we get employment. That could be the catalyst to get us to 3%. Heading into the weekend, I don't see us getting there. So right now, bonds looking more positive, but I think we're going to kind of hang near this 280 to 290 range instead of the 285 to 295 range that we have seen recently. Look for bonds to head into the weekend on a high note with the idea that next week, a strong employment report could be the thing that gets us to 3%. This is Todd Colvin coming to you from the floor of the CME Group.